Ladies and gentlemen, good day and welcome to the Bandhan Bank Q4 FY25 earnings conference call. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vikas Mundra, Head Investor Relations. Thank you, and over to you, sir.
Thank you, Sejal. Good evening, everyone, and a warm welcome to all the participants. It's a pleasure to have you with us today as we discuss Bandhan Bank's business and financial performance for the quarter and full year ending March 2025. We sincerely appreciate your time and participation. Today, we will take this opportunity to provide insight into our operational activities, significant achievements and challenges, as well as offer perspective on market conditions, strategic initiatives, and any notable changes in our business environment. To walk you through all these details, we are joined by Mr. Partha Pratim Sengupta, Managing Director and CEO, Mr. Ratan Kumar Kesh, Executive Director and Chief Operating Officer, Mr. Rajendra Kumar Babbar, Executive Director and Chief Business Officer, Mr. Rajiv Mantri, Chief Financial Officer, myself Vikas Mundra, Head of Investor Relations, and our senior management team at Bandhan Bank. We are happy to answer any questions or provide additional clarity on the current quarter's performance and our outlook moving forward. Now, I would like to invite our Managing Director and CEO, Mr. Partha sir, to brief you all on bank performance. Over to you, sir.
Thank you, Vikas. Very good evening to you all. At the outset, let me welcome you to the Q4 earnings call of Bandhan Bank. While my colleague and CFO, Rajiv Mantri, will walk you through the detailed Q4 financials, I would like to highlight a few key points from our recent performance and then we'll share our strategic vision for the next 2 to 3 years. As we have discussed in the previous quarters, the microfinance sector has faced significant stress and the overall liquidity tightness in the system has impacted both growth and profitability at industry level. However, I would like to note that the recent regulatory and monetary actions taken by RBI has been very, very positive, and we expect to see gradual steady improvement in the MFI segment in the coming few months. With the ongoing challenges in the microfinance sector, our team has worked well to manage the situation. During the quarter, while loan growth and profitability showed moderate progress versus our guidance, we remain encouraged by the continued resilience across key operational metrics. Notably, we observed a consistent increase in the share of the secured loan book, robust growth in retail term deposits, and a reduced reliance on bulk deposits. These have contributed to a more diversified book and a stable and sustainable funding profile. Even with the elevated slippages, headline GNPA and NNPA ratios remained broadly stable on a sequential basis, underscoring effective asset quality management. Additionally, our strong capital adequacy position provides a solid foundation for sustained growth and improved performance in the coming quarters. Despite heightened stress in the MFI segment during the second half of the year, resulting in elevated credit costs and moderate growth, the bank navigated these challenges with resilience and focus. I am pleased to report that the full year performance of financial year 25, we have delivered a reasonably strong performance. A snapshot of the same are net interest income. It was rupees 11,491 crore, a growth of 11%. Net total income was rupees 14,458 crore, a growth of 16%. Operating profit was at 7,389 crore, a growth of 11%. Profit after tax was rupees 2,745 crore, a growth of 23%. Return on asset of 1.5% and return on equity of 11.6% for the full year. Now let us turn to the broad numbers for Q4. As of March 31st, 25, our advances book stood at 1.37 lakh crore, reflecting a year-to-year growth of 10% approximately. On the deposit side, deposits have reached 1.5 lakh crore, showing a YOY growth of 12%, which outpaces the growth in advances. We remain focused on strengthening our granular liability franchise, and our deposit growth continues to outstrip the growth in advances. Retail term deposits grew strongly at 30% YOY, highlighting the growing trust and engagement from individual customers. CASA deposits now represent 31% of the total base, bringing the total share of retail deposits, CASA plus retail, to 69%. This marks a significant improvement in the granularity and stability of our deposit base. Additionally, we have effectively managed our funding mix by containing bulk deposits to 31% of the total deposits, further reducing concentration risk and enhancing balance sheet resilience. We continue to make steady progress on our diversification strategy. In this quarter, our secured book grew by 32% YOY, improving the secured mix to 50.5% compared to 42% in financial year 24. We remain firmly committed to maintaining asset quality. While credit costs remain elevated at present, we are focused on bringing them down over the couple of quarters. During the quarter, we have technically written off rupees 1136 crore. Despite an increase in slippages and higher upgrades and recoveries, our headline asset quality remains largely stable, with gross NPA at 4.7% and net NPA at 1.3%. PCR, including the technical write-up portfolio, was higher at 86.5%. For Q4, the net total income was rupees 3,456 crore and operating profit was 1,571 crore. The bank reported a PAT of 318 crore for the financial quarter. This, if we compare to the last year, it was very negligible at rupees 55 crore because of the one-time write-off taken in the last quarter of the previous financial year. As previously communicated in Q1 financial year 25, the bank adopted a conservative approach by increasing the risk weight on the emerging enterprises business portfolio from 75% to 125%, which led to a 362 basis point reduction in our overall capital adequacy ratio. However, in February 2025, RBI clarified the risk weight norms, reducing them to 100% or 75% for MFI loans based on certain eligibility criteria. These regulatory clarifications have had a favorable impact on our capital ratios, with CAR increased at 18.7% and Tier 1 increased at 17.9%, further strengthening our capital position and providing additional headroom for growth. Further, I am pleased to inform you that the Board of Directors has recommended a dividend of rupees 1.50 per share, subject to the approval of the shareholders at the forthcoming annual general meeting. Looking forward, as the MFI environment stabilizes, we are confident that we are well positioned to take advantage of the emerging opportunities. Our focus will remain on sound risk management, exploring new growth avenues, and continuing to enhance operational efficiencies. Moving ahead from the Q4 financials, as you may recall from our last quarterly call, I had mentioned about a few strategic initiatives. This included the formation of the Transformation Management Department, the Digital and Transaction Excellence Unit, the Market Intelligence Team, and the Credit Administration Department, all aimed at further strengthening the bank's quality loan portfolio. I would like to take a few minutes to update you on the progress we have made in these areas. The Transformation Management Team has embarked on a forward-looking transformation journey, driving innovation in the bank through focus on modernizing our technology, optimizing processes, evolving capabilities, and innovating our business and operational models. Key initiatives include expanding retail liability sourcing through our banking units, modernizing credit underwriting with business rule engines, and analytical tool-driven scorecards to enable seamless digital processing. We are upgrading all digital platforms to align services, channels, and customer needs for a smoother and delightful journey. Additionally, we are rolling out state-of-the-art digital banking units and integrating emerging technologies like QR codes, WhatsApp banking, and facial recognition to boost customer convenience, operational efficiency, and risk management. At the core of this transformation is a culture of agility and continuous improvement reflected in our internal workplace digitization efforts and the strategic use of technologies like AEPS, etc. Altogether, these efforts are setting the stage for a smarter, faster, and a more customer-centric organization. The Digital and Transaction Excellence Unit is driving digitization efforts and has successfully completed a closed user group rollout of QR code-based collection for our micro-banking customers, enhancing field-level collections. We are now set to gradually scale this initiative across our all networks. In parallel, we are making steady progress on key digital liability onboarding journeys, including savings and current account openings. In the government payment ecosystem, we have expanded our capabilities beyond GST and CBDT integrations. Notably, we have gone live with our partnership with SBI ePay, which has enabled us to gain access to the West Bengal GRIPS platform, further strengthening our presence in this space. Now, I will spell out the strategic priorities for the next 2 to 3 years. Over the couple of years, our strategic priorities will center on achieving deposit growth that outpaces the advances growth, with a strong emphasis on stable, granular retail deposits. We aim to expand our asset book with an improved secured mix, enhance asset quality, and continue investing in technology to elevate both customer experience and operational efficiency. Guided by a clear roadmap that embeds risk management and compliance into every facet of our operations, we remain optimistic about unlocking greater value for our stakeholders. Given the current macroeconomic environment, we are targeting an advances growth of 15 to 17% CAGR over the next 3 years, with a strategic focus on increasing the secured mix. We expect secured advances to constitute over 55% of the total advances by financial year 27. While both the secured portfolio and the EEB book are expected to grow, the secured book will grow at a relatively higher pace. The growth trajectory of the EEB portfolio will be aligned with the prevailing economic conditions. Liability growth is expected to outpace the advances growth, as building a strong, granular and stable liability franchise remains a key strategic priority. We will continue to drive growth in both CASA and retail term deposits while actively working to reduce reliance on bulk deposits. Leveraging the capabilities of our 1731 branches and nearly 4,594 BUs, we aim to deepen and mobilize more granular deposits. These initiatives will play a crucial role in lowering our overall cost of funds and enhancing balance sheet resilience. Cross-sell is a key initiative that we are driving with a unified approach under the philosophy of One Bandhan. As part of the same, asset teams are actively supporting in garnering liabilities, and likewise, the liabilities team are contributing towards asset generation. Through activation of our distribution network in branch banking and other segments. This collaborative effort strengthens our overall business growth and customer engagement and is being steered by a central cross-sell enabling team. The planned increase in the share of our secured loan book is expected to have an impact on NIM, but this is a conscious decision. As a result, we anticipate some moderation in margins over the coming years on a risk-adjusted basis. On operating expenses, we'll continue to invest in people, technology, and capabilities that support the bank's strategic growth objectives. As a result of these investments, we expect the operating expenses to asset ratio to increase by 10 to 20 basis points from the current levels or over the next 2 years. However, as operating leverage begins to take effect thereafter, we anticipate a gradual improvement in the ratio, reflecting enhanced efficiency and scalability of our operations. Asset quality remains the top priority, and I am confident that the guardrails we have implemented in the microfinance sector, combined with improving trends within the sector, will lead to a meaningful improvement in asset quality over the strategic horizon. While credit costs are expected to remain elevated in half year of financial 25-26, we are targeting to reach 1.5 to 1.6% on full year basis of the credit cost over the next 2 to 3 years, based on our relentless focus on improving portfolio quality through robust risk management and aided by improving MFI cycle. Our focus remains on a steady and sustainable improvement in profitability with a clear path towards improving ROA to 1.8 to 1.9% over the next 2 to 3 years, driven by better asset quality, improvement in other income, and operating leverages. To summarize, we remain committed to building a long-term value through disciplined growth, strong risk management, and continued investment in our core capabilities. With that, I now hand over to Rajeev Mantri, CFO, to take you through the details of the financials. Thank you.
Thank you, Sengupta sir, and welcome again everyone to the earnings call. Now let's move on to the business performance for the quarter. I'll walk you all through the key financial highlights and provide an overview of how we have performed. Let's start with the advances. As of March 2025, gross advances stood at 1.37 lakh crore rupees, reflecting a growth of 10% year-on-year and 4% quarter-on-quarter. In line with our strategic plan of product diversification, we are focused on growing the share of our secured book across housing, wholesale banking, and retail assets. The secured book grew by 32% year-on-year and now represents 50.5% of the total advances, marking a significant shift towards a more secure and diversified portfolio. The EEB portfolio saw a decline of 9% year-on-year, although there was a marginal increase of 1% quarter-on-quarter, reaching rupees 56,544 crore. This decline is primarily due to portfolio controls we implemented in response to the elevated risk in the microfinance industry. On the other hand, growth in the non-EEB book, which now represents 59% of our total advances, was strong at 29% year-on-year and 6% quarter-on-quarter. This growth was largely driven by robust performance across retail, wholesale banking, and housing segments. Specifically, retail assets grew by 98% year-on-year. Wholesale banking assets saw an increase of 35% year-on-year, and housing loans grew by 18% year-on-year, excluding IBPC. The impressive growth in retail assets was mainly supported by commercial vehicle and equipment loans, auto loans, as well as gold loans, which are the secured products within retail. From a business mix perspective, our advances are well diversified across various segments. EEB group lending represents 26% of the advances, SBAL at 15%, wholesale banking 27%, housing 24%, and retail loans have reached to 8% respectively. The bank has also made significant progress in geographical diversification. Over the past few years, share of advances from the east and northeast regions have decreased by 14% from 53% in FY22 to 39% in FY25. Conversely, we have seen an increase in advances from the north, west, and south, with growth in share by 3%, 5%, and 8% respectively. In terms of regional concentration, our top 5 states, West Bengal, Maharashtra, Bihar, Gujarat, and Madhya Pradesh, now contribute 59% of our total gross advances versus 60% a year back. Especially West Bengal remains the largest contributor at 23%, slightly down from 24% in the last year. Liabilities. As of March 31st, 2025, total deposits stood at 1.51 lakh crore compared to 1.35 lakh crore in the previous year, reflecting a healthy growth of 12%. Strategically, this growth remains higher than the growth in our advances, which we have continuously done in every quarter over the last 1 year. The bank continues to prioritize granular and stable retail deposits. Our total retail deposits, which include CASA and retail term deposits, grew by 11% year-on-year. Within this, retail term deposits showed a robust growth of 30% year-on-year. Retail deposits, CASA plus retail TD to total deposit ratio was around 69%, largely same as in the previous quarter, reflecting the strong focus on mobilizing stable deposits. Our reliance on bulk deposits remain lower, with the share of bulk deposits to total deposits marginally reduced quarter-on-quarter at 31%. CASA deposits stood at rupees 47,437 crore, reflecting a 5% year-on-year decline, but an increase of 6% quarter-on-quarter. While the growth has been on softer side, it aligns with broader industry trends. It is important to note that while CASA deposits have shown a year-on-year decline on period-end basis, on an average basis, CASA deposits have experienced a marginal growth on a year-on-year basis. The bank continues to focus on strengthening relationships across our customer base. It is actively working on enhancing our value proposition for different customer segments and expanding our customer base to drive growth in this area. From a geographical perspective, our top 5 states, West Bengal, Maharashtra, Uttar Pradesh, Odisha, and National Capital Territory of Delhi, now account for around 65% of the total deposits. Notably, West Bengal continues to be the largest contributor, representing 40% of total deposits, which is consistent with the previous year. Moving on to collections and asset quality. The bank's overall collection efficiency, excluding NPA, in Q4 FY25 improved slightly to 97.9% compared to 97.7% in Q3 FY25, a 20 basis points improvement. For the EEB book, collection efficiency excluding NPAs in March improved to 98.2%, up from 97.5% in December 2024. And for the quarter, collection efficiency also showed an improvement, reaching 97.8% compared to 97.4% in Q3 FY25, reflecting some improvement in the collection efficiency for EEB. For further details on collection efficiency, you can refer to slide 19 of our investor deck, which has more details. The collection efficiency for our PAR book, which excludes the DPD book, was at nearly 99.5% for the month of March 25. On asset quality, the gross slippages rose to rupees 1748 crore versus rupees 1621 crore in Q3, with the primary contributor being the EEB segment. Slippages in the EEB book increased to rupees 1349 crore, up from rupees 1196 crore in Q3 FY25. Recoveries and upgrades improved slightly during the quarter, reaching rupees 355 crore compared to rupees 282 crore in Q3 FY25 at the bank level. Additionally, the bank undertook write-offs amounting to rupees 1,136 crore during the quarter. As a result, the gross NPA and net NPA ratios remain stable on sequential basis at 4.7% and 1.3% respectively. The provision coverage ratio increased marginally to 73.7%, excluding the write-offs, and including the write-offs, as Partha said, talked about earlier, was higher at about 86.5%. The overall EEB DPD pool SMA 01 and 2 stood at rupees 1895 crore, representing 3.4% of EEB advances in Q4, compared to 3.8% in Q3 FY25, representing a 40 basis points improvement. This reflects an absolute quarter-on-quarter reduction of rupees 223 crores and reflects as an early indication of successful containment in the DPD book, which still is being monitored on an active basis. We continue to strengthen our collection mechanism with focused efforts to further enhance the overall portfolio quality of the EEB book. Details of the EEB DPD pool are covered in slide 20 of the investor deck. Credit costs, though remain elevated, showed improvement both quarterly and annually. Credit costs, including the standard assets for the quarter, stood at 3.9% of advances, down from 4.1% in the previous quarter. For FY25, the credit cost declined to 2.9%, representing nearly 50 basis points year-on-year reduction. Coming to the quarterly profit and loss, the net interest income for Q4 FY25 stood at rupees 2,756 crore, marking a 4% year-on-year decline. The sequential and year-on-year drop in NII was primarily driven by a shift in the advances mix towards secured products and the impact of elevated slippages, as well as the risk in the microfinance segment, as a result of which the microfinance segment growth was lesser compared to the last year. Net interest margin for Q4 FY25 came in at 6.7%, down from 6.9% in Q3 FY25, reflecting similar pressures from the secured loan mix and higher slippages. However, on a full year basis, the NIM remained resilient at 7.1%, just 28 basis points lower year-on-year and within the guided range of 7 to 7.5%. Net total income for Q4 FY25 stood at rupees 3456 crore, registering a 3% year-on-year decline. Sequential drop was primarily due to one-time gains recorded in the last quarter, including a claim payout from CGFMU and recoveries under the Assam Relief Scheme in the MFI portfolio. Operating expenses rose 10% year-on-year to rupees 1884 crore in Q4 FY25, reflecting continued investments in people, technology and infrastructure, and based on growth in non-EEB business volumes. As a result, the operating expenses to average assets ratio stood at 4.1% for the quarter, declined by 6 basis points quarter-on-quarter, and 4% on a full year FY25 basis. it was up 17 basis points year-on-year. Operating profit for Q4 FY25 came in at rupees 1,571 crore. Provisions for Q4 FY25 stood at rupees 1,260 crore, down 29% year-on-year. Despite the year-on-year decline as well as the quarter-on-quarter decline, provisions remained elevated during the quarter due to the continued stress in the microfinance segment, which is being seen across the industry. Provision line item also benefited from one-off gains of rupees 123 crores from a claim on the ECLGS portfolio that the bank has received. We have also been prudent in making provisions on the EEB portfolio in view of the certainty and stress we are seeing in the MFI sector, reflected in the PCR levels that we have maintained. The bank reported a net profit of rupees 318 crores in the quarter compared to 55 crores in Q4 FY2024. Thank you all for your patience hearing. And on behalf of the management team, I once again thank you for participating in the call. We'll now open up for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Vatsal Parag Shah from Knightstone Capital Management. Please go ahead.
Yeah, hi. Thank you for the opportunity. Couple of bookkeeping questions. So, what will be our proportion in Karnataka and Tamil Nadu as a percentage of advances?
So, Tamil Nadu, we have a share of only less than 1% in the total advances for the day, and Karnataka is 1.1%. So both are very negligible, and the DPD book is also very low, and only I would say the collection efficiency is also around 97% in these two states. So we are not that much impacted into whatever is happening in both these states.
And these are the percentages of total EB advances.
Yes, and number two is that we have seen that in both the states, the regulations have excluded the banks. The banks are not a part of the regulation. So, of course, this will have some, I would say, impact on the people or the borrowers there for that year. But in general, the other regulatory measures are not applicable for us.
Got it. And secondly, what will be our fixed book percentage?
Are you talking about fixed rate book?
Yeah, fixed rate.
So 48, it's around 48%. 48% of our loan book is around fixed rate.
48. Okay, thank you. That's it. Yeah.
Thank you. The next question is from the line of Piran Engineer from CLSA. Please go ahead.
Yeah, hi team. Congrats on the quarter in these turbulent times. Just a few questions. Firstly, on interest reversals, what was the interest reversal this quarter versus a similar number in 4Q FY24?
Sorry, could you repeat that question?
Interest reversal amount.
Interest reversals, Raju, for the quarter.
Yeah, give us a couple of minutes. We'll come back on this question.
Yeah.
Okay, sure. And secondly, what sort of impact do we expect on our deposit cost after this rate cut we've done on SA, as well as overall we are seeing term deposit rates for the system, wholesale and retail going down? Can you guide us to some sort of cost of deposits for FY26?
Yeah, so we have also reduced our interest rates on both savings bank and term deposits. So the rationalization has already been taken place. It will come effect from 1st May onwards. So we are expecting that around 30 basis point where we were giving on the highest bracket, so 8.05, it has come down to 7.75. But of course, the transmission in the deposit will not take place immediately. It will just take place as and when this deposit matured and renewed. But in the advances section for that year, almost close to 40% of our books which are on the EBR, linked to EBR, the transmission has already been passed. So definitely I can say some effect will be there for the first 2 quarters, but going forward it will be well managed.
Yeah, Piran, we don't have a specific guidance on the exact cost of deposits reduction, but as sir said, there are action being done both on the savings and term deposit to see in certain buckets where we can actually reduce the cost. And I think the results of that will come through the year.
Okay, and I think I heard sir say 40% is EBLR linked loans.
So I'll clarify that. The fixed rate loans, which means that there is no change due to any change in the market rate, is close to 55% of the portfolio.
And EBLR?
So in the remaining part, which is
5% is only MCLR and all the rest are EBLR.
So Piran, the remaining 45% of the floating loan, of that half would be EBLR based and another half would be MCLR based, repo based. Yeah.
Oh, repo based is EBR. MCLR is around 5%. We have a very small portion in.
Piran, on your previous question on interest reversal, during the quarter we had 69 crores as interest reversal.
And what was it on YOY comparison?
We'll get back to you, Piran, on that. Currently we don't have it.
Sure. And also just this MCLR, EBLR, I think there was some, you all were having a discussion. Can you just clarify, out of that 45% floating rate, how much is MCLR, how much is EBLR?
So to give you 55% is fixed, and of the balance 45%, our EBLR is 26% and MCLR is coming 19%. Yeah, that's
26 and 19. Got it. And just my last question on your MFI customers. Now around 8% of them are GNPAs. What percent of them would be actually paying some amount of EMI?
Yeah, Vikash, can you highlight?
So in simple words, collection efficiency from the GNPA book.
Yeah. So March where we collected around 80 crores from this collection from which has been there, but I think sometimes any highlights.
So, hi, this is Vishal here. Overall, from our 8% number, close to 25% of that 8% is paying us some amount. Some amount comes to one EMI or less than that, but some amount keeps on coming through from our GNPA.
Okay, 25% of the 8% number.
Yeah.
Got it. Okay, that's it from my end. These are all my questions. Thank you and wish you all the very best.
Thank you. Before we take the next question, a reminder to all the participants that you may press star and 1 to ask a question. The next question is from the line of Mohit Jain from Tara Capital Partners. Please go ahead.
Hello, can you hear me, sir?
Yeah.
Yes, we can hear you.
Yes, hi. Yeah, good evening, sir. So my first question is with regard to the SMA book for the EEB portfolio. If I'm looking at West Bengal, this quarter we are seeing a slight increase there in the SMA 0 bucket. So what can be the particular reason behind it? And also considering the fact in the month of April there has been some disturbances in some districts of West Bengal. So how adversely has it further been affected by it?
So one is because of the holidays. The last 3 days were holiday in West Bengal, as you all know, 29. So all over whatever the demands raised during this period, the borrowers could not pay. But this has been eventually corrected. Most of the accounts have been eventually corrected.
Mm-hmm. And so the trend we are seeing in the current month because of some, there were some media reports that in some districts there are some kind of disturbances. So any effect it is having on our collection?
Murshidabad district. So Murshidabad district, we have our 4% share of the, in NPA we are having around 4% and almost 88 percentage, I would say in April almost 88% are regular. The SMA 0 book percentage is 6%, SMA 1 book is only 1% and SMA 2 is another 1%. So we have, can give the latest figure as on April, we have 2,151 crores outstanding, So of which only 91 crores is in NPA. The other also delinquency book is very small.
Okay. And sir, the other question which I'm having is on the long-term guidance which we have given that, we'll be looking at a credit cost of somewhere near 1.5 to 1.6% over the next 2-3 years. And I guess, sir, you have earlier said that in the earlier conversations it has been said that, for EV book our target is around 2 to 3% in terms of the credit cost. Sir, if I'm looking at slide 21, it seems that, the loans which we have disbursed over last 1 year, the NPA in those books is coming at 4%, 3.5%, 4%, which is again very much on a higher side in respect of even the recent originations. So now, if this is the trend we are having in the recent origination, what gives us the confidence that over a longer period of time, the NPA of the credit NPA of the EV book is going to come down to, somewhere near 2 to 3%, sir?
No, so if you look at those figures, you see, it was 4% in financial year 24, Q3 and Q4. But if you look at the financial year 25 figures, it has come down from 2.8%, then Q2 is 1%, Q3 and Q4, if you just see Q3 is 0.1% and Q4 is nil. So gradually there is an improvement also, and as what Rajiv has also said, that in the overall DPD book also, we are finding that there is an improvement. It has sequentially it is coming down. Almost 230-40 crores it has already come down. The quality of these advances, we are now imposed the guardrails, as you all know that for the day we had our own guardrails, and apart from that the MFIN guardrails have also been imposed. So this is definitely is impacting for the 1-2 quarters where the business growth will get little bit impacted, but the stress level will also be contained to a large extent. So going forward, we believe that the loan loss provisions would be comparatively lesser, especially the incremental loan loss provision, and there will be a growth in the business. We have also kept a guidance of around 5,000 crores of growth in this EEB segment. So overall, with the growth in the business and also with the decrease in the incremental loan loss provision, the credit cost will improve.
And I think just to supplement a couple of other points. One is if you look at our number of lender criteria, we've already been sort of complying with to a large extent. 92% of book is Bandhan plus 2. So to the extent of that, the over-leveraging situation in our portfolio is fairly limited. And also, as you know that most of these loans are 1-year tenor, and therefore, I think the book that is of FY25 is a more reflective book, which will basically result. Of course, the risk in the industry is elevated, and we do expect the next couple of quarters to be challenged. But thereafter, as the improvement comes through, I think we'll be in a good boat to be able to come out of that.
Even if you look at our overall credit cost also, so 2.9% we could manage it for the entire year. So while the quarter Q4 credit cost is quite high. So the delinquency book, as you can see in that slide also for the day, that it is actually coming down. The loans which are given in financial year 25, their quality is much better.
So we expect the microfinance credit cost to come down from the current levels. And because of the change in the mix towards higher secured, we should also get further benefit. And that is why the guidance of 1.5 to 1.7% over the next 2 to 3 years.
Understood. So just one clarification. You said about a figure of 5,000 crores. That is the EEB disbursement we are looking for the current year, or the AUM growth for the current year, sir, FY26?
It's a net growth, what we are looking at it. Not the net growth.
That is, yes, so net AUM growth of 5,000 crores in the EEB book for the current year, FY26, sir.
Correct.
Okay. Thank you, sir. Thanks a lot for answering the question, sir.
Thank you. The next question is from the line of Anand Swaminathan from Bank of America. Please go ahead.
Thank you. I have a couple of questions on the EEB book. So just circling back to the slide 19, where you've shown the West Bengal, Assam, and rest of India collection efficiency. Just wanted to understand, which are your worst performing states, which are dragging down your collection efficiency to 98.2. So that's the number one question. Number two, in terms of disbursal rates, I get the 5,000 crore number, but in terms of month or quarter, when do we expect we getting back to a normalized disbursal level during the year? Those are my two questions. Thank you.
To answer your first question, our states which are not performing the way performance has happened in the eastern part are Maharashtra, parts of Gujarat, and Tamil Nadu, Karnataka, which are small for us. These are three and a half core states which are not doing well. Parts of Gujarat and Tamil Nadu, Karnataka. On the second question, I think the first quarter is going to be a muted one, and I think quarter 2 onwards, the disbursements should pick up. But by the end of quarter 3, I think we will have hopefully a normal year, a quarter the way it was there prior to a couple of years, and that should stabilize over quarter 3 and quarter 4. But first 2 quarters, specifically the first one, will have a muted growth only.
Sure. Thank you. Just to clarify, Maharashtra, Gujarat should be close to 96% collection efficiency even in March?
March was slightly better, 96 and a half on the collection efficiency front. Tamil Nadu was 96 and Karnataka similar 96.5.
Okay. And is there anything localized which is the problem which is keeping these states a problem, or it's just the over leverage issue which is extending?
Primarily at a pan-India level, it's a similar over-leverage issue, and like Rajiv clarified also, that Bandhan plus 2 relationship is for us, it's much higher than the counterparts, and it's at 92%. And there are small like Murshidabad has come up in the last 2 months only, so that has disrupted a bit for a couple of months. But we don't see this continuing for long, because then things stabilizes, and then after 4 or 5 week cycle, it comes back to normalcy. So there have been disruptions in localized disruptions up and running in some places, but not so rampant. The impact is more in Karnataka, Tamil Nadu over the last 3-4 months.
Sure. Thank you. And lastly, April, the implementation, has there been any change in collection efficiency?
Just can't get you, please repeat.
Sorry, Anand, can you repeat that?
Sorry, in April, after the implementation of the new guardrails, has there been any change in collection efficiency in any of the states?
So collection efficiencies for the month of April have remained stable. However, like the impact of guardrails have been more so on the disbursal side. With 3 lender norm, the maximum you could give. Obviously, there are other companies who also grant loans to the same customer. So that has got, but I think over a period of time, things will stabilize. Otherwise, we don't see any collection efficiencies really dipping down in the month of April, apart from 1 or 2 places where, which we spoke about earlier.
Also, Anand, I think April has had a number of holidays, so I think we'll have to see a more normal month like May to be able to get the full picture.
So because these are mostly weekly repayments, so holidays actually sometimes temporarily affect the quality of the asset, but that is normally gets taken repaid.
Yeah.
Sure. Thank you. That's very useful. Thank you.
And percentage-wise, while the delinquency is high in Tamil Nadu and Karnataka, but the overall
book size
is very, very low. It's only 100, 300, 400 crores around in these 2 states.
Thank you. The next question is from the line of MB Mahesh from Kotak Securities. Please go ahead.
So just on the question on this West Bengal again, you just kind of indicated what is the current month performance as we speak. Gave a number, I just wanted to clarify.
On the collection efficiency? Sorry, which parameter?
No, the SMA 0, 1 and 2. You had mentioned a number that the performance had improved in April. Just trying to check what was the comment on that.
No,
April number, we have not, obviously there is still, month to get closed, so we have still collections going for today as well.
But I can tell you 2 days back, the slippages percentage has actually come down, so almost I am having a positive of around some marginal positivity is there compared to March, yes.
But Mahesh, if you look at the SMA position as at March end compared to December end, definitely I think there is an improvement. I think the overall SMA book for EEB, we are seeing some bit of a reduction. And I think that comes through.
Yes.
Okay. Second question, sir. We are doing about 4% credit cost right now on an annualized basis for the last 2 quarters. In your assessment, how does that go over the next 2 quarters given the near-term numbers that you are looking at in the slippages on the EEB book?
So I don't think, Umesh, we give specific guidance on quarterly basis, but I think as we have said, due to the risk which is still there in the EV segment in the industry, in the MFI segment in the industry, and with the further tightening of the rating criteria from 4 to 3, I think it's natural to expect the next 2 quarters there will be some continued stress. Albeit we do expect some marginal improvement quarter on quarter, but with as Vishal earlier mentioned, by Q3 is when we expect, I think, a turnaround, some sort of turnaround to happen.
Okay. My last question, sir. You had given us a rough indicative ROE decomposition of how we should look at the franchise in the medium term. You have a margins today which is about 7%. You are indicating that number will be down by about 20 basis points. Is that how we should read it?
So maybe, Bayesh, I can give you broad indication on that. I think as our secured mix increases further over the next 3 years, we should expect, I think, margins, the NIMs to come down by say another 50 to 60 basis points. But what we are doing to offset some of the impact is focus on other income, where we do expect say another 20 basis points or so increase to come through. As sir mentioned, I think our costs, we will have to invest further to grow our secured book. So over the next 2 years, I think we will invest further, another 10 to 20 basis points increase. But thereafter, I think the efficiencies of scale should start coming in. And then credit cost is where we should start seeing a big reduction, right? And as a result of which, and I think the fee income will be also aided by newer initiatives such as transaction banking. We've recently got some trade products that we've launched. So those should start helping us as well. But as a net result of all of these lines is where we are saying from the current level, I mean, this financial year we had 1.5% of ROA. The latest quarter is lower. But from there on a glide path basis, we expect to reach around 1.8 to 1.9% of ROA by the end of the next 2 to 3 years.
And more so the containing the slippages. So we are not expecting the slippage because this year Q4 the EEB segment slippages was almost 10%, which will substantially come down. That we are expecting.
So, rather than just my clarification is, based on your numbers, you seem to be projecting what looks like a peak ROAs of about 1.8, which means that the ROEs are about 14%. Even if you have some disturbances to the portfolio, the corridor of ROE seems to be much lower that you seem to be targeting. Just trying to understand if the assessment of the numbers are right.
Yeah, so I think, look, this depends upon the pace of the transformation. It is a material transformation we are doing to improve the secured mix, which takes time. And as we're saying, we are investing to be able to grow that. So the pace of the transformation and how exactly these businesses grow up, and at the same time, the pace of the reversal of the cycle in microfinance. So it will really depend upon these 2 factors. But what we have not factored in this cycle is, let's say, further improvements to cost of funds. What we have not factored is further operational efficiencies that we can drive, because we are actually actively digitizing and bringing a lot of automation across our processes, both from a customer end perspective and internally. So some of these factors should give some further augmentation.
So I would rather put it very simpler that if you look at the annual ROA annualized on full year basis, it is 1.5%. Q1 and Q2 were good. Q3 and Q4 were bad. So the reverse will happen for this year. Q1 and Q2 will be comparatively little more challenging, whereas Q3 and Q4 will be good. So that going by the same philosophy, I think is 1.5, 1.6 can be maintained for this year. And this is the guidance we have given for the next 2 years.
So Mahesh, overall the larger transformation and the transition, as MD pointed out, that will take couple of years to come through. And obviously at this point we are targeting that kind of an ROE. And as it pans out, maybe over the next 4 to 6 quarters, we will relook at it and then come back to you with the fresh guideline.
Sure. Perfect. Thank you.
Thank you. The next question is from the line of Jay Mandra from ICICI Securities. Please go ahead.
Yeah, hi, good evening, sir. A few questions. First on capital, sir. So have we taken the full impact of RWA decline, or is there any some loan book where, and the lower risk weight are yet to be applied?
Yeah. So maybe I'll take that there, Rajiv here. As you've seen, the RBI clarification, the circular came through in February 25, and as part of it, we have assessed and we have looked at, and a large part of our EEB book, which is both across group lending and ISBAL, sort of fulfills the criteria which are mentioned, and we've been able to take the benefit of that in the RWA calculation. We've also, we are cognizant of the change that is coming from 1st April, which is for lending to NBFCs, and I think that should give some further benefit to the RWA calculation. That's not yet included in the March numbers, because that's applicable only from 1st of April. But the improvement on the total CRAR of 18.7%, which is the number now, compared to the earlier numbers, is really based on the February clarification.
New clarification that has come.
Sure. So the EEB proportion is taken care of, right? I mean, the entire, whatever the benefit was there on EEB, on individual as well as...
Definitely. Significant improvement has happened only in the EEB book.
That is correct, yeah.
Positive.
Sure. And secondly, sir, on, CGFMU, on incremental disbursement, are we taking CGMFU insurance, or we have discontinued that thing?
No, at present, we are not taking it. Yes, Ratan, you can clarify.
So you see, we have to do our own calculation of whether it is beneficial to the institution at this point going forward or not. We are not averse to it, but we are evaluating at what stage we would like to look at it. Because there is a threshold value beyond which, if the quality goes bad, it makes beneficial for us. So that's the stand as of now. We are evaluating very actively.
Sure. And of the non-EEB slippages of 3.5 billion, how much was from home loan and maybe the wholesale segment?
So wholesale segment, the slippages is very low. It is only 0.6% in the Q4 of the year. And housing finance, of course, the slippages has been 2.3%, a major part from the legacy books, what we have acquired from Group Finance. So for that year. So that is the broader number.
I think just to clarify on housing, wise the gross slippage comes to 2.3%. A large part of it gets collected during the month. And on a net basis, I think we end up at around 0.6% or so.
It may be last March, it was zero almost. It was zero slippage.
Correct. Net slippage, yeah.
Net slippage was zero.
Sir, would you have the rupees crore number? I mean, the percentage is sometimes tricky, or I can just multiply.
The housing on a net basis was only 70 crores of net addition on a gross slippage of 180. Yeah.
Okay, sure. And lastly, sir, OPEX growth, while I take your, we last quarter and last 2 quarters, we have said that the OPEX growth will be higher than loan growth. But this is primarily because new businesses, they are more OPEX heavy, right? That is how it should be. I mean, it is also a function of the loan mix change, apart from investments that you are doing in maybe people processes.
So I can take that. I think there are 2 or 3 key pieces. One is the newer businesses or the secured business where we're dialing up the focus require investments in people and technology, because we are making sure that we have the right talent in the right areas, in the right geographies, in the right segments. And also, we are investing in the latest state-of-the-art technology. As you know, last year we had the core banking system upgrade, and this now we are focusing on further systems like loan origination, which is going to with the state-of-the-art LOS providers such as Salesforce, and we are going to make sure that it has an enhanced customer experience that comes through. So I think that is the focus in terms of both the talent as well as the technology that is being deployed. And at the same time, I think for the distribution network in terms of branches to be able to drive a deposit growth.
So actually, yes, basically 3 things. One is that we have opened many branches in the last quarter of the previous financial year, not this year, and that expenses are adding up, but we will definitely get the benefit of business from these branches going forward. The second is that the investment in the IT, the depreciation cost is a major OPEX cost, but that's, as Rajiv has said, that both were necessary and the business will also come
once these are stabilized for the day. And the third is the manpower cost, because we wanted to invest in people. So in many areas where we have yet to start business, we have taken people, like in credit cards, we are going to launch soon, but we have already taken the resources, the major skilled resources. Similarly, in the other areas also, there have been some people recruitment take place. But yes, the strength of these will be derived in the coming months to come.
So last is just a small clarification. I think in the SMA 0, increase in SMA 0 in West Bengal, you have mentioned that that has also rolled back, right? So that would have come back to maybe, let's say, 0.9% was the Q3 number. Has that come to that level, or it is only, I mean, how you said that 2.3% rise from 0.9 to 2.3% is because of holidays and because of some localized turbulence. I mean, how does that stand? I mean, if you, in percentage terms, if you have that number.
So what we have done, see, 30th, 31st being a holiday and 31st was a holiday demand date, that's why it has elevated from 0.9 to 2.3. Of all that which have gone forward, had got all 95% of the ones which have carried forward. We collected 92.7, 8.3 which got forward, we collected 95% of that in the next 7 days. So that 1 week collection has already come through. But again, this month we had 4-5 holidays, so we will not see this kind of an elevation. It's a one-timer, and I think most of it has got collected thus far.
So these are only
Thank you so much.
weekly repayment period. You see, in our EB book, so for these group loans, we have a weekly repayment period, and that do get affected whenever there is a holiday, and more so if there are consecutive holidays. So every month, this month also we are having 3-4 days like that holiday. So it will be there, the elevated portion. If it comes if you take the data on that particular date, it will be shown a little bit elevated. But overall, there is no stress because those things get collected.
You see, SMA 1 and 2, those numbers have come down, and this 31st of March was one number, and if it happens again on the last day of the month, obviously the last day billing gets impacted. Otherwise, over the period of the month, we collect. So this one we specifically focused in the next 1 week, we were able to collect 95% of the 8% which had gone through. So then it became typically the same number of what typically goes through each cycle.
Thank you. The next question is from the line of Param Subramaniam from Investec Capital. Please go ahead.
Yeah, hi. Thanks for taking my question. So my question is mainly on looking at next year, right? So we've given guidances for the next 2 to 3 years, but if we look at next year specifically, would it be reasonable to say that ROA will be under pressure because of what I heard on basically that we are investing to operating?
So I have told you very clearly, if you look into the current year, Q1, Q2 was good, Q3, Q4 was comparatively bad for the year, and overall ROA we have maintained at 1.5. So this year it is just the reverse. Q1, Q2 will be a little bit bad, but Q3, Q4 we are expecting to be good.
Yes, sir. Sir, but at the same time, in the first 2 quarters, our operating profit profile was way higher. And it looks like it has reduced quite significantly, right? So is this...
Q1, Q2 of this quarter was quite good. So operating profit, income, EV, loan book, everything was quite good for Q1, Q2 for the day. But Q3, Q4, suddenly the situations have a little bit become, I would say, challenging. So this trend is continuing, but it is diminishing. So I think by Q2, all these problems will be more or less addressed. So Q3, Q4 will be a good year for doing business. So we are expecting the same way, the same trend will be there in the ROA.
And I think further to your question, Param, you're right that the secured mix percentage has gone up. So to that extent, right, the NIMs margin pressure are there. But as sir mentioned earlier, there are actions being taken such as reducing the cost of funds,
yes,
right, which should give some bit of an offset. So we'll actively look at the avenues available to us. But yeah, structurally we're moving towards a higher secured mix. So I think the impact of that will be there.
Okay, got that. Just on this bit again on operating profit, right? So we are at about, if we look at the last couple of quarters, if I look at operating profit as a percentage of assets, it's at about 3.3, 3.4%. And, that is lower than where we've generally operated. And if I heard correctly, we're talking about, mix shift, bringing margins down, and, still investing in the business. So how does this number look, say, how is it going to evolve over the next year specifically and then beyond that?
Yeah. So look, our full year ROA was 1.5%. Our Q3 was 0.9 and Q4 has been 0.7, largely impacted because of the elevated slippages in micro. But let's say, as I mentioned, once the cycle starts to turn for microfinance, we should see some relief coming from there and the improvement and more normalcy. And at the same time, as the capabilities that we talked about, which will give us higher other income and various other revenues, start to kick in, we should get benefit of that. So it's a sort of a glide path from the current levels to reach the 1.8 to 1.9% over the next 2 to 3 years. Right? Okay.
Got it. One more question, if I may. For this year, the margin pressure on the margin line, how much would the pressure because of the interest reversals have been, say, broadly in basis point? It's okay if I can get this offline as well. Yeah.
So as I have told that almost 25% we have already given of our loan book, we have already given the effect which is under EBR. The fixed rate loans will largely be unimpacted till we decide a change in the interest rate. Yes, one thing is there that the effect of the benefit on account of reduction in interest rates and deposit, that will only come over a period of time. It will not be immediate. The savings bank will.
I got that, sir. So I was asking on the interest reversals on the slippages, that would have some margin pressure.
Very small amount.
Yeah, that's a small amount.
Very, very insignificant. That is not 60, 70 crores.
Param, we can give you
for this year.
Yes.
Yeah. Okay. Thanks a lot for all this. All the best. Thank you.
Thank you.
Thank you. The next question is from the line of Ankit Bihani from Nomura. Please go ahead.
Yeah, hi. Thank you for the opportunity. I just wanted to know what is the yield on our microfinance portfolio and non-microfinance portfolio currently?
Yield.
I think the differential between the two yield is roughly around 10%. So EV is, I think, around or upwards of 20%.
22. So 22 and effective yield is
20%. Yeah, 20 and 10 roughly.
Okay. And the other part was that what has led to the negative tax in this quarter?
Yeah, I can clarify that. So as part of the review of the tax, I think there are two aspects that we have accounted for. One is what we call as the deferred tax asset on the ESOP. So as you recollect, in the last quarter, we had an accounting impact on ESOP close to around 166 crores. And as part of the accounting review, I think the deferred tax asset on that got created in this particular quarter. So that is roughly around 61 crores. And in addition to that, there is one of the old years income tax provision which has been released.
The assessment has been completed?
Linked to the assessment which has been completed.
The additional amount has been released.
So in total about 87 crores in the two items.
Okay, got it. Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I now hand the conference over to the management for closing comments.
Okay. We once again thank you all for attending this Q4 earnings report of Bandhan Bank. Just to conclude, I can say that we have, if you look at the year performance, the total financial year performance, so there has been a good increase in our net profit and also operating profit. And probably we are one of the very few financial institutions having sizable assets in microfinance have been able to give this result positive. That's one plus point I would just like to tell all the analysts. Thank you all.
Thank you all for joining in. Thank you very much.
Thank you. On behalf of Bandhan Bank, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.